right. Good afternoon, everyone. Thanks for joining us for a little lunch and education here. Hopefully the next 20 minutes will be helpful and useful. Some of the information that I'm going to share about a topic that becomes even more interesting in the environment of potential raise of capital gains taxes and some new taxes potentially coming down the pipeline with the new administration. There's been a lot of buzz over the last 4 years about opportunity zone funds, and I'm going to touch on some bullet points about what it is and the benefits and some of the risks. As a quick share of information, if you don't know me, my name is David Hansel, and I'm one of the managing partners of Lucern Capital Partners. We are a real estate private equity firm that focuses primarily on value-add multifamily projects up and down the East Coast, with a strong concentration actually in Charlotte. We have a large presence and continuing to grow there. The info that I'm about to share, I just want to make a quick disclaimer that I am not an attorney and I am not an accountant, that if you're making a decision about an investment, you should consult with counsel and the appropriate accountant to help guide you in those decisions. But really, there's more for giving you a general overview, discuss these opportunity zone funds. So we'll jump right in, and then at the end, I'll leave open maybe some time for a quick Q&A. So many of you may know, I'll just kind of give a little bit more detail about the opportunity zone funds were part of the Tax Cut and Jobs Act. And really the reason it was set up was to encourage reinvestment into areas throughout the country that are depressed or a lower economic value as far as the community, and try to help spur development, increase jobs, and a better standard of living. And so this opportunity zone got funded. There's 8,700 zones spread out throughout the country. These were delineated by the governors of every state. And there were certain criteria that they had to follow through. So you can go and visit and look on your local state or areas that you're interested in to see where these zones exist. But the idea is that you can take capital from a capital gains from another asset and put it into these zones, and there's considerable benefits that come along with that. And the sale and the capital gains don't have to be like kind as it is in what people understand as a 1031 exchange, where it's a like kind exchange. Here you can sell your assets in a stock or a business or anything, and then reinvest it into properties, businesses, or funds that are set up to deploy capital into these zones. So the idea and premise behind it has a lot of great purpose. It's good for investors. It's good for local communities. I'll put a question mark on that, and I'll touch on that later. But it's a tax incentive to spur development in areas that need economic improvements. So jumping right ahead, there are three main benefits to investing in these opportunity zones or an opportunity zone fund. So tax deferral, tax reduction, and tax exclusion. What does that really mean? I'll try to use an example and walk you through it. You can read some of these bullet points if you want while I'm discussing this. But the tax deferral is that if you were to sell, let's say, a stock and you had a $500,000 gain, if you sold it and did nothing else with it, you would wind up paying taxes on those dollars. There's an opportunity to defer those taxes similar to a 1031 exchange and place the profits into an opportunity zone via one of the vehicles I just mentioned. So you get to hold off on paying taxes on those gains. And the tax reduction is kind of a little additional benefit that, depending on how long you hold the asset that you're investing into in the opportunity zone or opportunity fund, if you go through a fund vehicle, is that you have a reduction in the cap gains after 5 years by 10%. You'll notice that the third bullet point is that there's a 15% reduction after 7 years. I wanted to put that in because it's part of the original plan. However, those investments have to be realized or sold by the end of 2026. So that is no longer viable. You could still qualify for that 10% and get that, if you hold the asset for 5 years. But the biggest and most attractive part of this investment, I think, and a lot of people are encouraged by, is that if you hold this asset for 10 years, you don't have to pay any gains at all on the return from the new investment. So the stock that we talked about, you're still going to pay, and you'll pay that reduced amount. But let's say you put that 500 into an opportunity zone fund and they built a hotel in, a rural area that was depressed and was designated as an opportunity zone, and you held that for 10 years, when you sell that off, if it was worth 600 or 1.5 million at the end, that 100,000 or that $1 million in profit is zero. There's no taxes that you're paying on it. So that's a massive incentive for people to want to go in to these funds. But there are real risks involved, and I'm going to kind of dig into that a bit, and so you guys can kind of get a better understanding. With any investment, you have the risk of the team that is managing it, right? So if you're buying a property yourself, you have to look at yourself in the mirror and say, is this right for me? Can I manage this? There are, I won't go too deep, but there are requirements that you put capital improvements into these assets that are equal to or greater to the acquisition of the asset. So you do have to invest real dollars. And so if you're not able to build a new project or, hire the right people to do it, you can go way over budget. The investment can become challenging at the end of the day. You want to make sure, if you're investing passively through a fund structure, that the managers or the owners of the fund are seasoned and have a good plan in place, and they have a good strategy that's thoughtful, and really conviction behind why they're doing what they're doing. The other part is that because most of these projects are going to require a lot of capital improvements, that means there's going to be, on real estate investments, development and construction. And so there's always a lot of risk in that, in terms of, are they able to execute? One of the things that we've seen with the passage of this opportunity zone funds is a plethora of funds and capital raisers putting groups together to take in capital and to go deploy. And some of these folks don't have a track record. So if you are looking at that, you want to be ultra careful about who's running the fund and what their strategy is. With anything, when you're making a real estate investment, location is super critical. And it becomes even more critical when you're talking about an opportunity zone. So, you're investing in areas that aren't strong economically. And the reason why the tax incentives are put in place is because the government wants these areas to be built up and try to improve the lifestyle of the families and folks that live there. But there's a lot of risk in turning around an area. You could build a beautiful new property, a new hotel or apartment building in an area, and the cost of building and the viable rents that are available for that area may not warrant any return on it. And you're hoping that through other investments, that 5-7 years down the road, that general area will improve drastically, that there's really a true path of improvement through that area. So there's a lot of risk in that. Now, what's interesting is, if you peel back the layers and you look at some of these zones, you'll find that there are some areas that are certainly very depressed, and other areas that are kind of in the path of improvement already. And so those areas tend to be a much lower risk profile, and should be considered if you are going into those areas. And so those locations have to be able to support folks that want to live there, the job growth and business and opportunities that are going to happen there. Tied to that is the socioeconomic benefit, which a lot of people want to invest with purpose. They want to do things that they believe in or are helpful. You can obviously take dollars and donate it to your local charity or something you believe in. But this is a way to blend those two things together and take capital that you have and put it to what is good use. And I put a big question mark, and not only help yourself, but really help local communities by improving them. So I put a big question mark next to that. And I think this is something that everyone should really consider. I don't know how many folks would look to go in purely on socioeconomic benefits, but there's a big question mark, because as a real estate investor ourselves, we've gone into areas that are kind of in the path of progress or improvements, and you take some level of risk in certainly doing that. But what I've seen, and this is my own personal opinion, is that a lot of times when you develop or improve an area, it's not necessarily raising that area. There'll be some of that. It becomes a displacement of folks that can no longer afford to live in a town or area that they called home for a long time, because these new projects and new businesses need to survive, and they're attracting other people into there. So I put a question mark there, and there's not enough data or facts to see yet what really will unfold. It will improve an area, but does it help the people that are there? And so if you're looking from a socioeconomic perspective, I think you want to really dig in and be careful, and also look at that team and their mandate of what they're going to put capital out for. Those are three really important things from a risk perspective that you want to consider. So moving right along, is it the right investment for you? Adding real estate to your investment portfolio, being in the industry, I can say that I think it's absolutely critical for every person to have part of their investment portfolio in real estate. It's no secret that the wealthiest people in the world, and a lot of generational wealth has been created through real estate, and a lot has to do with the ability to create equity, cash flow, some of the tax incentives, and this is an even bigger tax incentive overlay to what's been existing. At the core, you have to invest in assets that make sense. And so the opportunity zones, I think, kind of test that. First off, for you to really get the benefits of these of this investment, you have to be willing to commit and tie your capital up for, at bare minimum, 5 years, but really for the full benefit for 10 years. So 10 years is a long time. Not only is it a long time to tie up capital, but a lot changes in the market and tax codes and towns and things like that. So you're going into an unproven area, and you're going in for a 10-year period, and you're hoping that other investments follow and help rise the value of those assets. So can you commit for that period of time? Do you have the stomach to see an area that may not be really performing today hopefully grow because of these incentives? The other thing is that you can't just invest into an opportunity zone fund. This program was put together to encourage people to sell assets that they have that have a gain and move them over into a new investment to spur this economic activity. So you have to have a gain. If you've been running up in the stock market like crazy over the last several years, like everyone else has, and just nervous about when and if it's going to correct, it could be a great time to take those profits off the table and roll them into one of these funds. But again, if it goes in, the underlying investments have to be good. And because there's so much capital being raised and has been raised over the last 4 years, it's hard for these funds and groups sometimes to put the capital to work. So you could be looking at a fund where you'll make a commitment, but they don't have an asset lined up, and they're not sure when that will come. So that's something you have to be able to get comfortable with. And we talked earlier about the development risk. Regardless of the tax benefits, if the operator and the investment don't make a lot of sense, and there's a lot of construction involved, and construction costs move up further than they have, that could really turn what they underwrite as a potentially profitable project to one that's not profitable. Not to mention that you're mixing in with the the hopeful gain of that local area, which is an unproven location. So you're really buying in most cases to an area that hasn't proved out that your type of investment will work. The government's hope and everyone who's running these groups are hoping that if you build it, they will come and the values will improve. So, you have to take those into consideration. I think the core is, does the deal work and stand alone on its own? At Lucern, we currently are not invested in any opportunity zones. We have assets in opportunity zones, but we didn't set up as a vehicle that could benefit because some of the pieces, as far as like the amount of capital we were going to put in, wouldn't qualify. But you want to make sure that the underlying investment can kind of stand the test of time. So moving along here, I will open up for some questions. We have 3 or 4 minutes. If anyone has questions, I'm happy to answer them, and you can reach out to me at the information down below and discuss opportunity zone funds. I'm happy to always talk about real estate in any manner, and can talk in more detail about what our firm does and the opportunities we provide to investors. So I will just wrap up by saying thank you very much. I appreciate you taking a few minutes out of your day to join us. I hope you'll continue to follow what we're doing here at Lucern. We really pride ourselves on helping and providing thought leadership in the industry, whether it's directly for investments that we're making or the broader economy and some of the things that are happening through the industry. So feel free to visit us at lucerncapital.com. You can contact me again directly at the info, and I wish you all a great day. Thank you.